hope that the recorder is working well for. Uh, so there are several housekeeping issues that I am going to get to. The most important one is that you know that I have pushed the exam and the last day to June 10. I have made the time 6:30, just so people that for some reason or other may get delayed in office will still have time to get here. It is going to be online, and it is definitely going to be a group test. So formation of groups are important, and the program has agreed that if we do that, that means if we have the last class on June 10, then there is no need for a June 7 class. So there will not a July 7 class. So there will not be another class on July 7. That class has been moved to June 10. And my expectation is that I will use that class for the exam. Now, a 3-hour exam is actually quite intense. However, because this is a group exam, I am hopeful that people will be able to finish the exam in time. There may still be a take-home group test meaning group case analysis, but I have not decided on that yet. It is not included in the package. So if I go in that direction, then the package will have to be created. Now, if I have not heard any objection from anyone, that means that at this point of time, it is final. No class on July 7. Class moved to June 10, which is a Wednesday. I checked your schedule for other classes. Wednesday is clean. So that evening, Wednesday evening, June 10, will be the final class. And of course, attendance is mandatory on that day. Attendance is not mandatory on other days, but definitely expected, as is participation. With respect to the groups, let me show you and I will definitely post it immediately after the class. Here is the groups that I formed. Now, I'm sorry, I have to share it. Hope you can see it. Several groups were requested. I have created those. I think I received 4 requests. So you can see the 1, 2, 3, 4. Those were made on request. And one of the groups, the names I could not actually match. So there are 19 students. Only one group has 3. The other 4 groups has 4 students. So this will be posted. Now on the left is the alphabetical order. On the right is the group order. So you can see groups have been numbered from 1, 2, 3, 4. Again, as I say, the ones that were on request, obviously there should not be any changes. I would not like to make any changes on the other 2 also. But if there is any circumstance because of which you do not want to be in that group, then sure. At least 2 questions, 2 students asked if they could take the individual exam. Sure, there is that option as well. However, if you cannot finish it, then there will be no extra time allowed, and I will not be held responsible for a poorer grade than you would get as a group. Now, I will talk about the exam a lot more, of course, and between I think the last series, the 6 classes, I think is June 27 maybe. And after that, I will have a review session also between June 27 and May 27 and June 10. There will be a review session for the exam. And of course, one of the concerns that the students always have is what's the exam going to be like? So there are more or less broadly 6 topics. So you can expect 6 questions, maybe 5, but each question, those of you that have taken classes with me, will be sort of like a case. So, for example, I will tell you that we are going to be starting with Mogen Inc., which is a convertible bond. And there are going to be some text questions. There will be some problem questions as well. So basically, I will give you a particular company, and I will tell you that this company is considering a convertible bond of such and such characteristic. What is the value of the conversion, and what is the what is the coupon rate of the bond? That is the question in the Mogen Inc. case. So if you understand Mogen Inc., then of course you will be able to do the problem. Now, I received a couple of emails from Edward. It is not that I ignored your emails, Edward. He applied the put call parity problems to a couple of options, but seems to me, Edward, that you really do not have a question, but I will still start the class because you wrote to me directly with any question or clarification that you may have. So go ahead. I'll stop sharing at this point of time and see what questions you have. Hopefully that will help other students as well. Go ahead, Edward.
Yes, sir. Thank you very much, sir. I was just trying to look at several scenarios in trying to solve that question, either by using the continuous method or using the discrete method.
Yeah.
So yeah, so when I solve it using the continuous method, there is a little bit slight difference that
Yes.
resulted into there is almost an arbitrage if you use the continuous method. So
I know that you got some differential between the left-hand side and right-hand side, but
yes.
it looked very small to me. But do you think that there is any, tell the class as to what is the differential? So basically what he did, let me explain, that as you know, that the put call parity is actually a model where one side, there is a left-hand side and there is a right-hand side. Now, remember, it is really doesn't matter as to what you put on what side, because you can definitely transpose variables and use any different combination you want. But one common use is to take one of the option prices to be given and solve for the other option price and compare the theoretical price according to put call parity with the market price. And if there is any discrepancy, which looks substantial, usually above 5 to 6% at least, then you might say, well, there might be a trading opportunity. Because remember, there is going to be considerable transaction cost in the arbitrage. You have to buy, then sell. So there is considerable amount of transaction cost involved. So that's basically what he did, that he took a pair of options and then took the characteristics from the market and then saw whether the two sides actually matched. And in one case, it looked like it almost exactly matched. In the other one, it did not. So go ahead, Edward, explain what was the purpose of your exercise and what did you learn from it?
So basically, based on some of the formula that I use, I literally just take into consideration the underlying asset price and that of the strike price, and then that is on the left hand side, because based on the put call parity, it says on the left hand side, it say is the call option plus the PV of the strike price. And then on the right hand side, you have the put option plus the underlying asset price. So once you go through that one, you realize that it's only because of I use the continuous discounting method that resulted into the difference, which is like about 0.21. So, but when I use the discrete method, I have literally something like 0.03 as the difference, which I assume should be the transaction cost. So there will be no arbitrage opportunities for that one, because the difference is very, very small.
Well, I mean, I would have to say that I'm glad you checked, because it comes, the confirmation comes from a student that this is a pretty tight arbitrage. That means that the market is quite efficient, and that is definitely, when I looked at your solution, and of course the approach is correct. And it made me happy that, yes, the model definitely works, no doubt about it. Market is efficient. But you remember that this particular relationship, we knew that the market is quite efficient with respect to this one, particularly for stocks on which people write options or buy options. They are heavily traded, they are extremely liquid, so there is no reason for the market not to be efficient at all. Achha. Are there any other questions? Now, I should tell you that one of the cases which I did go through, but did not actually review, possibly in as much detail, is option trading strategies. There will definitely be some option strategies in the test. Remember that these are, like, for example, there are some very basic ones. Of course, protective put and covered call or naked call are the most popular or most widely used. Then combinations like a straddle is definitely heavily used. So those are the ones that I think you should be focusing on. Now, there are some that become a little complex because people try to do risk management with that. And the reason it becomes complex, as you know, when we looked at the collar strategy, is because of the transaction cost. As I mentioned to you, Alex will tell you he was in the student fund, that one of the things that the FERM program students were allowed to do was to trade options. And I know they actively considered protective put, but then decided not to buy it because of the heavy transaction cost. Because as you know, that calls and puts become more and more expensive as the market volatility goes up. If there is one factor that will push option prices high, it is market volatility. So the paradox here is that it is the market volatility that you are trying to protect. But then if you are buying put option to protect that, the put option itself will cost you a considerable amount. Once again, as I said, a protective put is nothing but an insurance. So you know that, if, for example, if you are going to buy a car insurance, the first thing that they will be looking at is your driver license and your driving record as to whether you receive tickets or if you had any accidents and all that. So what are they trying to determine? It is they are trying to determine how reckless you are, meaning that how uncertain and how unpredictable is your driving, which you can consider to be basically the volatility. And as you know, that if you are risky, then your premium is going to be high. And if you are very risky, then the premium is going to be very high at a point, to a point where either the insurance company will not sell you, or you will simply say the premium is too high, which happened with the students, and they decided not to buy it. That no, we are not going to be buying the insurance, and they decided not to do that. But remember that in that case, they could do that. I mean, life insurance is the same way, of course, which is why they insist that you do your physicals in time and every year. If you don't, then they stop supporting insurance, and you cannot buy the drugs and all that. So these are ways to force that people behave in a certain manner, because this is the classic moral hazard problem. Moral hazard problem meaning that you buy insurance and then you start abusing the car. Now you will note that the insurance is going to be less in your own car than on a leased car, simply because people tend to abuse the leased car a lot more than an owned car. Anyway, I'm not going to get into any of that, but the point is that that is exactly the model that applies to options. That volatility it is. That's it, nothing else. So those strategies you should be looking into. I may also, I just haven't found any interesting ones, but from time to time, there are articles on option strategies, strictly from the risk management perspective. Now, for example, options on NVIDIA have suddenly become very expensive, because NVIDIA, I think, is expected to announce earnings or maybe quarterly earnings tomorrow, and the market expectation is substantially high. Some people are already talking about $300 and all that. You can imagine what that will do to the option price of NVIDIA. Now, of course, it is very difficult these days to satisfy the market. So the market may have already priced in, although I did not see much movement in the stock today. I was tracking it. There wasn't any movement. Very little, as a matter of fact. I think it's almost like a thaw before the storm. And I have no inside information or inkling, but there are indications that NVIDIA may actually substantially beat the estimates. So you can understand the amount of pressure on that stock. In any case, people have spent billions on that, and it's obviously a leading AI company, but you just don't know. I mean, if the market is expecting a 10 out of 10, and if they come out with a 9, there might be a huge downside risk. So that's one of the things that you have to, calibrate your holdings. That it is not what whether they will beat or not. It is also whether they are beating it to the point that the market, that means that the delivery exceeds the market's expectation. If not, then they might beat, but the stock will drop. So that's what makes these companies or stocks extremely risky and the options extremely interesting. So anyway, I'm now going to get into, I think we have discussed options in substantial amount, and I'm now going to get into convertible. And so we'll start with the Mogen Inc. Are there any other questions from the material? Okay. I'm going to start with the Mogen Inc. Case. So let me share. So you remember that this is a company that wants to raise, I don't remember how much, a substantial amount of money, but they are actually considering, of course, the choices that they have is bank loan, issue bond, or issue stocks. Of course, retained earnings is another source, but they did not go in any of that direction. First question will be, why is it that they considered convertible bond? And what are the advantages of convertible bond? I am hoping that people have, at least some people, have read the case and know the answer to this question as to what's this particular, complex security and which companies, under what circumstances, are most likely to consider it. What are the advantages?
I'll answer it, but I did it last week. But if you want me to do it again, I'll do it again.
Of course. Sure. Please go ahead. Thank you.
Okay. Convertible bonds are a type of bond where you have the option at a certain price to convert it to stock of the company that you're buying the bond in. And at the same time, the company has a callable part to it where if it goes up to a certain amount, they will convert it for you to limit their loss as far as giving up too much stock when you convert the bond.
Yes. I think you have covered the basic essence of it. All convertible bonds have what is called a conversion price. Conversion price basically is the equivalent of strike price. For example, let's look at the features of this bond. But before let me finish the thought. So there is a conversion price, meaning that the price or the strike price of the call option. That means that if all bonds will be considered to have a face value of $1,000, So $1,000 divided by that conversion price is what is called the conversion ratio. Conversion ratio is nothing but the number of shares that the bond is convertible into. So that you might actually think, I mean, from a stockholder's perspective or even the bondholder's perspective, as you can understand, lower the conversion price or the exercise price, more attractive is the option. That means that if the current stock price, let's say, is 50, and if you make the conversion price 75, then you are actually saying that the bondholders will have to wait for the stock price to go from 50 to 75, which is 50% gain before that convertible bond becomes attractive. So if you make that determination that I'm going to put a 50% premium on the current stock price, then you realize that basically you know that the value of the option is inversely related with the strike price. So if you increase the strike price, that's definitely to the management's pleasure, but the market is not going to like it, because higher the strike price, lower is going to be the value of the convertibility option. Now, one of the statements that I have made repeatedly in all my classes is that whenever I'm talking about bonds, that all bonds are issued at par. That means that the underwriter has to make sure, to the extent possible, that the bond is issued at par. That means when the bond hits the market, then the price of the bond at which it hits the market should be equal to $100. And there are ways of making sure of that. And let me see if anybody remembers that. And those of you that took the class from me, I think the fall class, that one of the cases that I do in my classes is the, I forget the name of this company. Anyway, and they were issuing bonds to actually do a merger. And what does it mean to say that the bond must be? What does that statement actually mean for the benefit of those who may still be a little uncertain about it? Can you help, Cliff? What does that mean?
To be issued at par?
Yeah.
Well, you want the price to be, par means that the price would be equivalent to what the face value of the bond is.
Exactly. That means that, and I will say that it is, because it is expressed in percent, that it will be $100. Now, there is only one way to make sure of that when you are issuing a straight bond. What is that?
You would have to match the cash flows to what the expected yield of the bond would be.
Pretty close, but I will put it slightly differently. I understand your statement is correct, but I don't know if I were to grade it, I could give you a 10 out of 10. I know what you mean by cash flow. I would say that the interest rate on the bond must be equal to the yield to maturity. That will basically be the same as the cash flow.
Yeah.
So if I deducted points and then you came and challenged me, I'll possibly give it back to you. The point here is that the yield to maturity and the coupon rate, which is the interest rate, must be equal. Now, that's for a straight bond. That means that a bond that we are most familiar with. Now, the question to the class is that a convertible bond has two components in it. One is the convertibility option, and the other is the straight bond option. That means that all convertible bonds also have a straight bond component. What does that mean? That means that the bond also pays interest. My question to the class is that everything else being equal, will the yield, or rather not the yield, the coupon rate on a convertible bond be the same as a straight bond of the same company, same maturity and everything same? Will the coupon rate on the convertible bond be the same as if the company is if the company issued a straight bond, would the coupon rates be the same for the two bonds?
I don't think so, Professor.
Yes, go ahead, Edward.
Alexei, this is
Yes,
Alexei.
please, Alexei, go ahead.
Yeah, I don't think so. Because like it goes for the risk adjustment, right? So I would say the coupon rate for convertible bond would be probably smaller than for a conventional bond because it's risk adjusted. Basically, everything's risk because it's like for a company, it can be a big loss when they make it makes it very favorable because it be converted to the stock. Yeah, I guess that's the logic that I'm using.
Your answer is correct. And another way of looking at it would be that, of course, the convertible bond will have a lower coupon simply because you are giving them the convertibility option. And that cannot be free because the convertibility option means that the company is actually giving you the stock at a substantial benefit because the stock price may go up. So
Professor.
that is the idea here, that because the convertible bond will be issued at a lower coupon rate than the straight bond, everything else being equal, that's what makes it more attractive, that it is less expensive for the company until this is converted. It is less expensive for the company to actually issue the convertible bond than the straight bond.
Professor.
That's one advantage. The other advantage is that, okay, so why not issue the stock itself? Because if you issue the stock, then you would have to do it at the current price, which you think is actually lower than what it should be. So effectively, you are actually issuing the stock at a higher price, which is the strike price. So the strike price, that's why they're saying at a 30% premium or 25% premium or even higher. So that is another distinct advantage, that you are effectively issuing the stock at a significant premium to its current price. Now, I mean, obviously nothing in the market is free. So the question is that, are there any downsides to it, to the company? You don't have to answer that because it takes a little thinking, but I will come back to the point I was making, that clearly the convertible bond has two components in it. One is the convertibility option, and the other is the straight bond component. Now, the rule that still remains the same is that the bond must be issued at par. Now, if that is the case, then when the bond is issued, it will be $100. That cannot change. But of that $100, a chunk of it is actually the convertibility option. That means that the $100 must be the value of the convertibility option, or on 1,000 also. You can do it on 1,000 also. In fact, maybe let us talk in terms of 1,000. Of that 1,000, some of it will be the convertibility option. And 1,000 minus the value of that convertibility option would be the value of the straight bond, which obviously will be less than $1,000. And that's what makes the interest rate lower. Because when it is going to the market, it is not going at the coupon rate, rather at $1,000 or $100. So the interest rate that is built into the bond is going to be accordingly lower. So the first step in the convertible bond is to actually find the value of the convertibility option. Then take the $1,000, subtract the value of the convertibility option to get the value of the straight bond. Once you know the value of the straight bond, so that the two components are up to $1,000, you know the maturity, you know basically you know the maturity, and you know the yield to maturity also, because that doesn't change because it is the same company. Then you can easily back out the coupon rate. That's the whole pricing. So when the underwriter is pricing a straight bond, the only thing they have to determine is what is the coupon rate. And that's easy because all they have to do is know what is the yield to maturity of this bond. Whereas when you are choosing a convertible or issue a convertible bond, then you have to know two things. One, what is the conversion ratio or conversion price, and what's the coupon rate? Now, once you determine one, the other one is automatically determined. But the first step is to find the value of the convertible option. And that's what we will do next. But before I do that, let me take you to that option calculator that I showed you last class, because that will become very handy. So you may want to open that. Let me just see. No. Let me stop that for a second. And I seem to have lost it. So I will have to go back to the okay, here it is. Let me go back now. This is actually the Husky City option calculator that I posted for you. I always use the first one. The CBOE also is very good, but I like this one better. So here is the here. So let me keep this page open. Come back to the Mogen Inc. case, and as you know, that you need 5 different variables. You need the stock price, which is the easiest. You need the exercise price, which of course has to be specified. And then you need the risk-free rate, which is easy. Time to maturity, which I believe is 5 years. And you also need the volatility. Now, in the case itself, the most of the data is actually quite easy. 77.98 is the current stock price. But let me actually read this part as to how they actually determined. So in light of Mogen's objective, Manavie decided to propose a conversion premium of 25%. Now, this immediately means that the conversion price that they are setting is 25% above the current stock price, which is 77.98, which was equivalent to a conversion price of 97. Mogen management would appreciate that the conversion premium would appeal to a broad segment of market, which was important for a $5 billion offering. Now, from a management's perspective, let me ask you a very simple question, just to make sure that it is clear to everybody. Do you want a high premium or a low premium? Everything else being the same, do you want the conversion premium to be high or low?
You want it to be higher.
Exactly. But everything comes at a cost, right, Cliff? So if you become too greedy, what is the problem?
People won't buy your bond.
There you go. That means that there is a trade-off. On the one hand, you want the premium to be high. On the other hand, you also want the premium to be realistic. That a 25% gain on the stock price is possibly credible in the next 5 years. But is 75% credible? Possibly not. So that's the trade-off. And of course, the underwriter will not accept it either. So on the other hand, Manavie knew that management would be disappointed that the conversion premium was not higher. So management felt that the stock was selling at a depressed price. We made that clear, which is why they do not want to sell the stock. depressed price and represented an excellent buy. In fact, part of the rationale for having the stock repurchase program was to take advantage of the stock price being low. Manavi suspected that management would express concern that a 25% premium would be sending a bad signal to the market. So, Cliff, since you have been talking about this, why is that a bad signal?
You're giving the signal that you don't think your own stock is going to be going up.
Exactly. That means that you do not sound very confident. That's exactly the point. Thank you. Bad signal to the market. Notice that none of this is actually too complex. None of this is math or anything at all. It's basically the intuition. For sending a bad signal, a low conversion premium could be interpreted as management's lack of confidence in the upside potential of the stock. For a 5-year issue, the stock would only need to rise by 5% per year to reach the conversion price by maturity. If management truly believes that the stock had strong appreciation potential, then the conversion premium should be set much higher. Anyway, if Manavi could convince Mogen to accept a 25%, now, from an underwriter's perspective, they want the conversion premium to be low because the market will be very, very receptive of a low conversion premium. They will jump to it. 25% conversion premium, then choosing the coupon rate was the last. This is what I explained, that once you tell me all that I really need to know is what is the conversion premium. That's it. The moment you say that, the whole problem can be programmed in the computer, and the computer will give you the answer in 2 seconds. So once there are 2 things that you really need to determine as an underwriter and as a management. What's the conversion premium? And as soon as you decide on a conversion premium, it's very, very easy mathematically to work out the coupon rate. So was the last piece of the pricing puzzle to solve. That's what the case is about.
Professor?
Yes.
So does it mean the premium increases when the volatility increases and the time to maturity increases?
Well, I mean, that's definitely one way of looking at it. Sure. I would not really say that volatility increases. I think it is the market expectation of the underlying, prospect of the company itself. That if it is a company that the market is expecting to perform very, very well, then you can go with a higher premium. So, but the volatility may not really be very good news when you are trying to sell something to the market. It is not the volatility that you actually want to be high. It is the prospect over the next 5 years. So, because he was proposing a mid-range conversion premium, investors would be satisfied with a modest coupon. Let me ask another obvious question. What do you think is the relation between conversion premium and the coupon rate? As the conversion premium goes high, will the coupon rate be higher or lower?
Has to go higher.
Who said that?
Cliff.
Yes, explain that. The answer is correct.
Because there's going to be less chance of you hitting the strike price or the conversion price, the higher it is. So the options can be less valuable, which means that the coupon has to increase in value.
That's right. That means that if you become too greedy, the market is not going to accept a low coupon rate. They will squeeze on that side. So the trade-off is very clear, that there is a clear trade-off between the conversion premium and the coupon rate. So, but if the market is, if the management is very confident, they might be willing to pay a higher coupon. That question cannot be answered unless you are actually on the management side, because you do not know what their expectations are. But most of the time, these companies that are really young would not go very aggressive on that. So, because they have to convince underwriter also. with a modest coupon based on Mogen's bond rating. This is a critical piece of information. The company would be able to issue straight 5-year bonds with a 5.75% yield. But that information is very important. Why? Because remember that in order for me to price a coupon bond, I need to know what is the yield to maturity of that bond. Meaning, what is the basically what's the rate of return that the market is expecting or demanding of that company. And as soon as you know the yield to maturity on a straight bond, it is very easy to set the coupon rate. So for a bond that has a yield to maturity of 5.75%, 5-year bond, what is the coupon rate? If it is a straight bond, what is the coupon rate? If you have to issue a straight bond, 5-year bond, with an yield of 5.75%, what is the coupon rate that you are going to choose?
It's got to be the same.
It's going to be the same. Exactly. Why? Because you want the bond to hit the market at par. Okay. So therefore, Manavi knew that the convertible should carry a coupon rate noticeably lower than 5.75%. Why? Because of the convertibility. And this is a question that we discussed just now. The challenge was to estimate the coupon rate that would result, and this is a statement I also made, result in the debt being issued at exactly the face value of $1,000 per bond. So the valuation of the bond is very nicely explained on the very last page of the case. Any questions so far? So I will be building the case on basically this information. So what are the pieces of information that you really need? You need what is the yield to maturity of the straight bond of the same maturity for the company. Once you know that, then you know that if it is a straight bond, that has to be the coupon rate. However, because the convertible bond has a convertibility option, the coupon rate can be lower. The question is, how much lower can you go, or will you be willing to go? So the first step is to actually decide on the value of the convertibility option. So here is the solution, and this is already posted for you. The particular file that I'm using, this is the case example, and is 98. Settlement is 110, because this is when the 110/2006 is when the bond was being issued. Maturity is 110/2011, 5-year bond. 77.98 is the current stock price. So I'm actually first finding the value of the convertibility. That is this. Premium is 25%. You remember that. So I have increased this number by 25%, and that is the formula. You will see that there is a formula built in there. So that's the strike price. So I already know the two variables. Now, I also know the maturity, that it is 5 years. And I know the 4.465-year treasury bond. Where do I know that from? Right here. It is given in the case. Let me show you. Here is the treasury note, 5-year treasury note, 4.46. That's the number I just showed you. So we know the S, we know the X, we know the time and the 4.46. 5 years is 1825. That means that 365 times 5 is 1825 days. Now I need the volatility. The volatility directly is not given here. But what is given is the options quotations. And from there, I can actually extract the volatility because I can calculate the implied volatility from there. Any questions so far? Okay, now I'm going to show you one of them as to how to actually do it. So this is the 77.98 current stock price. Option, let me take the, let's say exercise price 75 or 80. We can take either of them. There are 8 of them given. You have to calculate the implied volatility in all 8 of them and then take the average of it. Okay. So let's take the 80 and the 102 days. I'm going to go to that website now, right? Oops.
So, Professor,
Go ahead.
so when it comes to this calculator, so what is the biggest impact on the option price?
Oh, of course, always the volatility.
Okay.
There's no question about it. And I'm going to just input the numbers. So 77.98. That's the current stock price. And I think I said I will take the $80 exercise price right here and the 102 days. 102 days and $80. So here is the 102. Oh, sorry, I have to change this. 80, 102. Risk rate we know is 4.46. We are going to calculate the volatility. So I am going to erase that. And there is no dividend yield. So I'm going to make that 0. But you must put in a number there. If you don't, then it's not going to work. Okay. Now let me go back and see what is the option price. The option price is $3.85. So I'm going to go here. And put in the $3.85. And I see that the implied volatility is 26.27%. I will do this for all 8. Now, remember, this is for call options. You can change it to put options also. For that, you have to go up here, over here, and change it to put options. That's it. You are not working here. So the numbers that you put in here supersede the numbers that are here. So 26.27% is the implied volatility of the option. Lot of times, students make the following mistake, that because this particular calculator is filled with data of another company, they almost never put in the actual option price here. If you don't, then the implied volatility that you will be getting is completely wrong. So each of these cells will have to be filled. I will wait, I'll pause for a minute or so if there are any questions. This is very, very friendly. This is the implied volatility according to the Black-Scholes option pricing model. Okay, looks like there are no questions. So I'm going back. This is the case. I am going to be, we'll have to calculate, which I'm not going to do in class, of course. I just showed you how to do it. We'll have to calculate and I'm not going to give you 8 options in the test. I'll possibly give you 2. So calculate that one possibly will be a call option, another one possibly a put option. And, you know, there will be at least 2 questions on options, and of them will be on the same company. So the first question will be on the option fundamentals, including strategies and valuation and all of that. Second question will be the convertible bond. So, and it will be the same company. So you will have the option quotations and everything. So, and I will tell you which 2 options you should be using for calculating the implied variance. Now, coming back, and I will take the average of these 8 implied volatilities of these 8 options to calculate the actually implied volatility that I'll be using in the case. Now I go back to the spreadsheet and I can see that I have used 23% as the sigma. You should check this number out. And of course, if there is a 23% seems like a little low to me. Maybe I was teaching the class and I changed it for some reason. I don't remember. But with that, here is the call option value. So F12 times 365, what is F? Sorry, no, right here. 1576 is the value of the call option, but we'll have to calculate it. So let's go back to the calculator again. 7798, 97.48. So we'll go back. The only thing that will change is the sigma and the 1825. So 7798, and what was the value of the? So we are going to have to use the calculator twice. 97.48. That is the number I was forgetting. 97.48. Then the number of days is 1825. And 4.46 remains the same. This one, I believe, is 23%. And that should give us a price of the call.
Sorry, Professor, I think that the number of days is kind of has a typo.
Yeah, that one, the 2, yes.
It should calculate. It is not calculating. I don't know why. Oh, right here. Theoretical price 15.82. Sorry about that. So the price is right here. And it's slightly different from the number in the Excel, 15.76, but sufficiently close. Does everybody follow what I did? Notice that when I was trying to find the implied volatility, I did not put in a number in the volatility. So when you are calculating the implied volatility, the calculation is at the bottom. When you are calculating the option price, given the volatility, the number appears here, 15.82. And the number on my spreadsheet is 15.76. So each option is 15.76, but because the exercise price is 97.48, the number of options embedded here is 1000. Remember, that is the face value divided by F10, which is 97.48. So 10.3 options, I multiply 15.76 by 10.3, the conversion ratio. That means the convertibility option is 161.68. That means the value of the straight bond is 1000 minus the 161.68, which is 838. So the face value is 1,000, and the value of the straight bond when it hits the market is not going to be at par because of the convertibility option. It has to be 838. So the question is, what is the coupon rate? Now, I don't know of any direct way of finding the coupon rate. I find it by the iteration, and I'll show it to you. But before I do that, are the steps clear to everybody? Any questions? Okay. Now I'm going to show you how I got the 1.980. Do not forget that the bond actually has a yield of a 5.75. You need that information now. So yield to maturity, YTM, sorry, is 5.75. We know that because I will come back and check this out again. 5.75 is 0.0575, and we will have to put it in the percent. How do I know that? That was given in the case that the yield to maturity of the bond must be 5.75%. So now I'm going to use my favorite FX, and I'm going to use the price one, which is financial, then price. You have seen me use this in other classes as well, so I'm not going to, unless there are questions. So I'm going to use the price. Okay. And I know the settlement. This one is 110/2000. Remember, 5-year. And the maturity is this. Rate, I don't really know. Coupon rate is what I'm trying to find. But I know that the yield to maturity is 5.75. So there is no harm. You can just go ahead and put that one. So just go ahead and put the 5.75 there. Messed it up. Sorry. I'm going to put this one there and put the same number for the yield so that we will get 100. Remember the redemption, you have to put 100. And do not forget that this is biannual or semi-annual rather. So the frequency is 2. And you see that it is 100, but 100 is not what we really want. So, oh boy. Sorry about that, folks. Price. Maturity. Rate and A, both will be 5.75. Redemption is 100. And then the frequency is 2. And now I have the 100. Oh my God. Now it is okay. So I don't want 100. I want 83.82. So now I'm going to have to start reducing the coupon rate. So going back there, that means the target I want is 83. There may be a better way of doing it. I just don't know how to do that.
Solver
I'm
should be
just-
able to do it.
Solver should be able to do it. Yes, you can definitely use the solver, but let's see what happens if we go to 2.5%, 0.025, pretty close, 86. So we need to go down a little bit more. Maybe let's see what happens with 2. 83.90, that's sufficiently close. That's a 1.980 right there. So we can just put it at 2%. So the coupon rate is going from 5.75 to 2.2%. That's it. That's the full pricing. And if they go at this, it will definitely be selling at close to $1,000 or $100, whichever number you like better. Any questions, folks? Let me ask if anybody has any questions. Edward, do you have any questions?
Yes, sir. No, sir. I'm okay.
All right.
Yeah.
How about you, Gokul? Hello?
Not out, Professor.
Huh? Any questions, Gokul? I don't know if he's there. Anyway. Christine, you have any questions? Hello, Christine.
No, I don't have any questions.
Okay. All right. Fine. So that basically is what convertible bond pricing is all about. Lot of different information, but all market information. And two things that, remember that this particular case becomes a little easier because the yield to maturity was given. Yield to maturity, I mean, of course, I will take a case, or rather a company that is very heavily traded, because that's what makes it makes options interesting. But let's talk about Microsoft. If you want to find the yield to maturity of a 10-year bond to be issued on Microsoft, what would be the best source?
You're just
Probably
looking at
looking at the current corporate bonds were issued.
Yeah, that should be the first thought. That does Microsoft have a bond right now that has close to 10 years to maturity? Just take a look at the yield to maturity of that one, and that's your number. If you don't, then you take the yield of a 10-year treasury plus the spread, which is basically nothing but that is the WorldCom case. I remember that where we looked at how to actually find the yield to maturity, or rather the coupon rate on these bonds, where it was a tranche of about 5 different bond issuances. And you can definitely take a look at the yield to maturity of the WorldCom bonds that are trading, but there were only 1 or 2. And then you can take the treasury yield plus the spread. Spread meaning what is the additional amount of basis points that you must add to reflect the riskiness of the company on top of the treasury bill or treasury bond. That's it. And all of that information is market driven and available in the market. Any questions, folks? Very fascinating, but risky. But that's what makes it interesting. And what the underwriter and the company is trying to determine is what is the remember, as I say, the number one characteristic of the bond that you want to determine is what is the premium on the current stock price that I want to go with. Once that is determined, everything else follows. Everything else.
The only question I would have is, should we be using a binomial tree to do the option pricing, since this can be exercised at any time, or is this just close enough for government work type
Oh,
stuff?
I mean, the binomial tree, if you use the binomial tree, obviously you'll have to go an infinite number of times, simply because, I mean, if you reiterate it 2 or 3 times, you're not going to get the number. No. I will all actuals. There's no question about it. It can
Okay.
be shown that if this were a actual science or a math class, it is not going to be too difficult to show that if you push the binomial tree to let's say n number of time periods where n is
It'll
very
converge
low,
to Black-Scholes essentially.
it converges to Black-Scholes. Yes, that can be shown.
Okay.
Yes, yeah. So there is no need to go there because it's more tedious. But the two-state option pricing model is very intuitive because management actually understands that, and we won't have time in this class. But the two-state option pricing model has been used for project evaluation very heavily. Where the one uncertainty about the project of any project is whether the future cash flows will justify taking the project now. All of you have done in net present value or NPV problems, but the NPV problems always take the cash flow to be given. But the cash flow is not given. Cash flow is always highly uncertain, and that uncertainty can be actually modeled using the two-state option pricing model. Okay, folks, if there are no more questions, I will go to the next case, which is the fixed income arbitrage. But before I do that, we need to set it up in the sense that we need to see what it is that we are actually trying to arbitrage. For that, I will go to the Wall Street Journal. And here is the Wall Street Journal. And I will go to the bond quotations.
Sorry, Professor, you're not sharing.
Oh, sorry. Let me actually open it and then I will share. Or maybe I can share right now. So here is the Wall Street Journal. And I will go to the markets and finance. Under that, I will go to bonds and rates. And we see the yield curve here. You can see that yield curve, I've talked about yield curve extensively in other classes, so I'm not going to get into that. But I want to look at the treasury quotes. And here is the issue about, let's take a 10-year treasury bond. So 2036. Notice there are 2 of them here. 2 of them here. My question to the class is, are the yields to maturity on these 2 bonds going to be the same? Or should the yields to maturity on these 2 bonds should be the same?
Well, I don't think so, Professor. They're a year apart. I don't
Huh?
think so, Professor. They're a year apart.
Uh-oh. That's
Think it's
because I pointed to the wrong one.
the wrong one.
Yeah.
Yes.
Sorry about that.
No worries.
Okay. Now you see, you can clearly see that the coupon rates are different. One is 4.125, the other is 4.500. Should the yields to maturity from these bonds be the same? The answer is yes.
Yes, Professor.
Yes. Because for remember, treasury bonds by definition have no default risk. If they have no default risk, the two things that they have, one is that it is the same maturity. That's it. Because the source of uncertainty, or the for let's say if it were a Microsoft bond and not a treasury bond, then the Microsoft bond would have a higher yield because it is not default free. But and if it is the same maturity, then they have to have the same yield. But why are the coupon rates different? They are the same yield. Why are the coupon rates? These two numbers that you see on the left hand side, the left hand column, these are the maturity years. 2026, February 15 is the maturity of the bond.
Correct, Professor, because they were issued at
Why
different
are
time.
the coupon rates different? Go ahead. I'm sorry.
Oh, because to answer your question, they were issued at different time.
Yes.
So one of them might be 10-year bond, another might be 30-year bond, or
I
20-year
would
bond.
not go that far because
Mhm.
you may be right. I don't know. Because I mean,
Because
of course, we
10
can
years, it's
tell
10 years
when they
from
were
now,
issued.
right? So it's
Huh?
10 years from now, so it's at least 10-year bond.
Oh yeah, of course.
Roughly. Yeah, but
You
it
know,
might be. Go ahead. Mhm.
I would say that possibly the second one may have been issued this year because it looks pretty close to the 10-year rate right now. But the other one clearly was not issued at the same time because the coupon rates, remember, given the discussion we had just a few minutes ago, the coupon rate reflect the yields to maturity of these bonds at the point of issue. That means what was the equilibrium 10-year rate at that point of time? And given that the rates have gone up, I would say that maybe this one was, the second one was issued this year, and the other one was possibly issued earlier, or maybe a 20-year bond. Who knows? But the yields must be the same. So the question is, are the yields the same? So one of them is 4.657. The other one is 4.576. They are not the same. Actually, they are wide apart. Do is to make sure that students can find the yield, but I'm not going to do that unless there is somebody or some bodies that once again want to see it. I will show you one of them. But is that necessary here? Well, I will take the silence as given that no, it is not necessary. But the difference between the two is almost 24 and 57, 81 basis points. That's substantial. Now, I am not, if this were true, then there is a clear arbitrage opportunity here. There's no doubt about it. And I will explain how. Because you will see, if I recall, that the spread, meaning the difference in the yield of this similar pair of bonds in the case was around 36 basis points. And the hedge fund manager jumped on it. This is far more than that. This cannot be sustained. so I'm thinking that these prices were taken at different times during the day. I mean, I did not actually know that these two bonds will show such a difference. I randomly picked it. But remember that when you are actually trying to check the yields to maturity of any bond, two bonds, treasury bonds, it has to be, first of all, treasury bonds, because otherwise the risk equivalence will not work. There's no way. Because any other bond that you pick will have default risk. So this will not work. So you have to pick a treasury bond, and you have to pick another bond which has the exact same maturity. And then you look at their individual yields. And if the yield, given the case, I mean, if the yield is around 50 basis points or higher, then there might be actually a arbitrage opportunity that you can exploit using program trading. Can somebody actually use the Excel to conform to the class that the yield to maturity of 4.657 is actually sufficiently close to what you are getting in the Excel? Please do that. Otherwise, I will check it. Who would like to do that? Since I can see Edward. Edward, do you remember how to do it? Oh, you cannot see the Wall Street Journal, can you? Okay, let me go back and write down the numbers. So check just the first one. 2/15/2036, 4.125 is the coupon rate, and the ask yield is 95.276. Do it on the ask yield, or rather ask price. 97. Is it? Sorry, is it 97? No, 95. 95.276. These are the numbers you need. Maturity is 2/15/2026. Coupon rate is 4.125. Price is 95.76. Edward, can you check, or anybody else? I'm just asking him because I can see him. Anybody else, can you check what is the yield to maturity of this bond according to Excel?
I'm just watching this on an iPad, so I can have a computer in front of me.
Say that again?
I'm just watching the video on an iPad, so I don't have a computer in front of me.
Okay, that's fine. That's absolutely fine. Anybody else?
Take the numbers.
So, Edward, use
Yes,
today's
sir.
date as the settlement date. Use
226.
5/19/2026, 5/19/2026 as the settlement date. Use 2/15/2026 as the maturity date.
Let me take the
Rate,
parameters. Yes. The settlement date as today.
yes, 5/19/2026. Maturity is 2/15/2036. Coupon rate is 4. And the only other number that you need is price 95.276.
Coupon rate is 4.125.
Yes.
Let me see.
Did anybody else get it? I don't hear.
You're asking for yield to maturity, right? For the bond with the 4.5, correct, Professor?
Yes. So you will use the yield macro.
Professor, the yield The
Yes,
yield
go
to
ahead.
maturity,
Yes,
right? You're asking the yield to maturity. This is
yes.
4.612%.
What? How much?
4.612%, around that.
Well, hold on. That is impossible because the
2026.
bond is selling very close to its full price. So the yield to maturity will be a number very close to 4.125, slightly higher because the price is 95, but it cannot be 12. You cannot lose that intuition. Was that Christine? Christine, do you understand what I'm saying? Hello? Let me actually go back to my Excel.
Okay, so can you go on it said the yield to maturity coupon rate is 4.125.
4.125. So let me put in the settlement date of 19/2026 and 2/15/2036 is the
7.
maturity. So now I am going to go to FX and I'm going to check for yield. I mean, we may not get the exact same number, but we should get something very, very close. Okay.
Something around 4.72, but go ahead.
Possible. Let me finish this. That sounds credible. And maturity is this. Rate is 4.125, 0.04125, 95.276, if I remember, was the price, 95.276. Do not forget the redemption of 100. And do not forget the 2. And 4.73 is what I'm getting. I heard a number very close to this. Who was that?
That was me, but I took the other one. I by mistake took the one with 4.5.
That's okay. That's okay. No problem, Alexi. 4.74. Let's now go back and check the actual.
Professor, I think the price is 95.256, not 276.
Let me go back. I will show you what 256 is the beat price. That's not what we want. We want the ask price, 95.276. So you are right. But the price we want to take is 95.2. And what they have is 4.657. Not quite what we have, about 6 basis points difference, which is okay. We can live with that, but sufficiently close. But the most important thing is the difference between the two. The only reason I wanted to go through this exercise is because I will now take you to that case. Does everybody follow what I'm doing?
Yes, Professor.
Okay. Let me stop here because I have to actually pick up the case. Give me just a second. All right. We won't be able to finish it before the break, but that's okay. I will go back here and open the case now. Okay, here is the case. Fixed income arbitrage, and I usually highlight the most important part, but maybe right here, yes. So let's read this part. Franny was studying two bonds with identical maturities, most important point. One was a US Treasury bond that paid a semi-annual coupon rate of 4.25, which is very close to what we are doing, annual rate, and that matured in August of 2015. The other was a US Treasury bond that paid a semi-annual coupon of 10.625. Notice the difference between the two. It's striking. But they had the same maturity. Why? Because these were issued at different points in time. One may have been a 10-year bond, the other may be a 30-year bond. So notice that coupon rate of 10.625. Who wouldn't love that? Annual rate, and that also matured in August of 2000. So the maturities must be the same. Coupon rates don't have to be. Summarizes remarkably, the yields on these two similar bonds are quite different. The higher coupon bond was priced to 3.61, while the lower coupon bond was priced to 3.26. As I told you, I remembered only 35 basis points. Compared to that, the two bonds we were looking at, I'm quite surprised at that, and in fact, pleasantly surprised, because it gives us a very nice example for the class that the difference is almost 80 basis points. Franny thought he could exploit the yield spread of 35 basis points. Now, what does it mean to say that there is an arbitrage opportunity here? Because we have discussed arbitrage opportunities, and we have said that an arbitrage is basically, there is an arbitrage opportunity if the prices of two assets that have the same risk and the same cash flows at the same points in time have different prices. Let me repeat, two assets of the same risk and same cash flows at the same points in time must sell for the same price. But we are not talking about price here. Keep that in mind. We are talking about yields. That means that we are not really saying that the prices of these two bonds are the same. They are not. I can tell you they are widely different. Why? Because one is a 4.25 or 4.25, and the other one is a 10.625. So obviously, the higher coupon rate is selling at a much higher price. But the yields must be the same. So remember that when you are actually doing arbitrage with treasury bonds, or any bond for that matter, that have the same risk, price is not the target, because the price is going to be different because the coupon rates are different. The target is the yield to maturity. Now, what she is saying that these two yields must be the same, but one is 3.61 and the other one is 3.26, and they must be the same. And so she wants to exploit the 35 basis points. Now, remember, when there are two assets that have to be the same price but are mispriced, are out of line, then one must be sold and one must be bought. And when they become aligned, you reverse the transaction and keep the arbitrage profit. Here, which bond should be bought and which bond should be sold? That has to be on the yield, not on the prices. Which bond must be bought and which bond must be sold? Now remember, you want to buy the asset whose price you expect to go up. You want to sell the asset whose price you expect to go down. Which bond price do you expect to go down?
You expect the 10.625 10% bond to go down and the 4.25 to go up.
Explain why. One hint I will give you, Cliff. It will help if you tell me in terms of the yield, because the focus must be on the yield, not on the coupon rate, not on the price. So
Yeah.
tell me in terms of the yield, which
The-
bond would you like to buy and which bond would you like to sell?
You want to buy the lower yield one and sell the higher yield
Ah,
one.
yes. Yeah.
Does everybody agree?
Yeah. It's correct.
Okay. So let me take a number 3.61. Are you going to buy that one or sell that one?
You buy it.
Right.
Yes, that's the correct answer. Why? Because the only way this arbitrage can disappear is when the two yields become equal. In order for that to happen, the 3.61% yield must drop and the 3.25 must go higher. That's the whole thing. That's the arbitrage. Franny was aware that government bonds of the same maturity occasionally could have different yields when one bond has more liquidity. Liquidity meaning it is trading more. That is when one bond was more heavily traded and therefore more quickly and easily sellable. That means that the difference is because of the difference in trading. Like for example, one bond may be on the run, that one other one may not be. Treasury bonds when okay. It was not unusual to see such liquidity differences between US Treasury bonds when one had been sold by the Treasury recently on the run, and the other had been trading for many years and so was off the run. So on his screen, Franny had a chart that plotted the yield difference between the two. The point that she is trying to make here is that I have been actually tracking these two bonds, and there has been other times when the yield actually shot up, but I could not take that or exploit the opportunity. Now, she says in the next paragraph, the yield reappeared, the spread had reappeared in March of 2008, roughly at the time of JP Morgan's purchase of Bear Stearns. Remember, 2008 was the last terrible financial crisis. Higher, Stearns at a level higher than could be explained by a liquidity difference between the two bonds. The spread soon had disappeared, but then it had reappeared in June. That means that it is coming and going, but he could not exploit. Then by October 15, the yield had reappeared yet again, last paragraph, and by November 4th, it had grown back to the previous peak of 35 basis points, had not acted to profit from the yield spread in early October, but it seemed that the market had just given him a second chance. So we understand that the trading is buy the higher yield and sell the lower yield. Fine. But what we really still need to understand is the mechanics of the whole thing. That means, how much money is she going to make when this trade must be reversed and the two yields match? How much money is she going to make? Remember that on both of them, if we say that this yield will be equally divided, then the first one, that means 35 basis points, if you divide that by 17, so the first one has to drop from 3.61 by 17%, which will be about 3.44, and the other one has to go up by 17 basis points, roughly again 3.43 or 3.44. That's it. So the question is, how is the price first bond going to go up? How much when the yield goes from 3.61 to 3.43 or 44? How much is the other one going to go down in price when the yield goes up from 3.26 to 3.44? That's it. That calculation I will show you after the break. But before we go to break, I want to come back and show you why I was so excited about these two numbers. 4.657 and 4.576. That these numbers look significantly different from, or rather, there is a clear arbitrage between the two. Much higher than what we have in the case. So I am not suggesting that people made money. I do not know. But one thing I know, that if these numbers were at the same point of time, then there was a lot of money to be made. The only question is whether these prices were taken at the same points in time. I do not think so. After the break, I will go through the case example. Any questions, folks?
No, Professor.
Peter, you have been quiet. You have any questions, Peter?
Not right now. Thank you for asking.
Sure.
Professor, the difference there is about 78 basis points.
Huh? Yeah. Well, because I divided the 35 basis points difference, the spread, by 2.
Okay. Okay.
So one will, the other one will come back, will go up by 17. Just divide that by 2. Now, it's not necessary that will always happen, but that's the only thing we can assume. That's all. I don't know why some students do not show up, but it's okay. It is more important to me, the people that are showing up. Now, since I have not heard, I mean, I will check, of course. I have not heard any objections so far. We will definitely move the exam to June 10, and tentatively, I am telling you that the review session will be on June 3. So we will work 2 Wednesdays after our 6th class. Now, June 3 review session is optional. I will announce, and if students have any questions, whatever questions you have, you are welcome to join. If you decide not to, that's absolutely fine. I will record. No new material will be discussed unless there is some material that I cannot cover in the next 3 days. And I need half an hour to do that, or an hour. I may actually review that material on June 3. My plan is not to do that. After the formal classes are over, I will not do that. But the review session definitely will be about the exam and any questions you have on the material. So June 3, mark your calendar. I will follow up, of course, with another announcement by email. June 3 and June 10 will be the review session, and the exam will start at 6:30. The review session may also start at 6:30. I did not want to change the time of these classes because these are classes set by the program. I don't want to change it, but I think I will allow a little more time on the exam day so that nobody misses it. All right, folks, it's 7:45, for actually 7:46. So I will come back around 8 or a minute after 8 and continue. Let me put the recorder on pause. All right, folks, I'm back. Hope you can hear me. And we will finish this case, and we may not actually need up to 9 o'clock, but we shall see how it goes. And there is an easy way of actually doing this case, but the case itself makes it a little more complicated than it has to be. So before I get into that, I want to actually go back to the Wall Street Journal quotation once more. So let me share that. And let's focus on these two bonds. 4.657 and 4.576. So the difference is roughly about 81 basis points. So let me ask the class, which one would you buy and which one would you sell?
$4.576 and sell the 4.657.
4.657 you will sell, and
Yes.
4.576 you will buy.
Yes.
And what would be your expectation, Edward?
With the expectation that the 4.657 will come down.
By how much?
Well, if you take a look at the put call parity in order to eliminate the arbitrage, so it should be like around 78 basis points for them to be equal.
I'm not following what you are talking about, but the difference between the two is roughly about 80 basis points.
80 basis points, okay.
Well, the difference between 4.657 and 4.576 is roughly
Okay.
about 80 basis points. And I agree with you that you will actually buy the 4.657 because that yield has to drop. But my
Yeah.
question is by how much?
Would it be 40 basis points?
That's correct, 40 basis points. So if it goes down by 40 basis points, now remember, it may not exactly go down that much because it will depend on the trading as well, but it will be
Yeah.
within that range. The 4.617. Now, what we can do, because you have actually bought it, we can see what would be the price at 0.617%. So let's go back to the Excel once more.
81, yes.
And now we are
Yes.
going to, so the two yields are going to be, one is going to be 0.0417. And the other one also will be hold on, let me just, no.
You have a bid-ask difference in there somewhere.
Hold on, let me just make sure I am, yeah, 4.657,
First one is 4.657.
that means 4.617.
657
657 minus 40 basis points is 617.
is yes.
So
Yes.
617. Yes. And now we can actually put it in percent. Okay. The other one actually will go up by 40 basis points and will be
4.576 plus
576 plus 40 is roughly 16. That means 616 and 617. So both of them will be 617. Now we can actually price it. So let's look at the price. Price of I'm just going to say price 1, and I'm going to use the FX and the price. The settlement date is this one. Maturity is this one. The coupon rate of that particular bond is 4.125. So 0.04125, and the yield is 4.617. So this number and redemption is 100 and 2. 96.17. And what was the price? 95.276. So the profit 0.276. Where did it go? Huh? That is strange. Seems to have disappeared.
You have different spreadsheets open?
Is that right? Maybe.
Yes.
Sorry about that. So the profit is
0.89.
this price. Sorry. This price minus
95.276.
95.276.
276.
Yes. About 89 cents. Let's not do price 2. Settlement, maturity, that one has a rate of, I think, 4.5. 4.5, yes. And the price is 99.126. So 4.5, 0.045. Yield is 4.617. Redemption is 100. And then we got the 2. Now the profit
$9.125.
99.126.
126. 126, yes. 126. 99.08.
Oh,
0.46.
now the total is the sum of these two.
$94.
94 cents. Doesn't look that impressive, does it? However, there is something that we need to keep in mind, that the cost of this is cost of this strategy. So we bought this one 95.276, or rather we bought this one 95.276, and did we sell this one? No. Yes, 95.276. We bought this one, so this would be a negative. Plus 99.126. So you start with $3.85 in your pocket and make another 94 cents. This is make sure you follow all of this, and if anybody has any questions, because I'm developing it in class, and I cannot guarantee that there is absolutely nothing missing about my logic or my calculation. So I will post this one in case numbers, and you are most welcome to come back tomorrow and ask me any questions. But any questions on this, what we have done? Because I will now show you, rather on the arbitrage fixed income, I did it in the wrong spreadsheet, but that's okay. I will actually copy it on the fixed income arbitrage. But when I go through that case, you will see that they have actually done it slightly differently. But it makes sense. So any questions up to here? Did everybody follow? Cliff, do you agree with this?
Yeah, I just can't read the numbers on this in the Wall Street because it's so
please check the
small.
numbers. Yeah, please check the numbers.
Because there's going to be a bid-ask spread that's going to be against you one way, and it's going to be for you the other way.
That's right. That is the one adjustment that I should make. But you see, the problem is that I know the bid-ask spread now. I don't know the bid-ask spread later on.
Yeah. Okay.
But you have a good point, because you know what we should do possibly, because let's go back.
That could take all your profit away in reality.
Well, I mean, I don't know about that. Let's just go back and take a look at what you are saying, because I think you make a good point. See, what he's saying is that spread. So there is one that you are going to be buying. The buying is the 4.657. So there you really should be using the ask price. There is no question about it. But the other one you are selling. So there you really should be using the bid price. So the profit will actually be not as high, but there is still going to be some profit, because these two prices are actually quite different. So you'll start off so I think the point he's trying to make is that rather than taking 99.126 for the one that you are actually selling, take this one, 99.106, because there you are actually selling to the market. And I think that 20 cents difference should be adjusted, but there is still no doubt that you are making money. And so that is how I would do it. But there is another approach which is a little more methodical, and that's what the case does. So let me take
the case went into different durations of the bonds.
Yeah, that's right. That's exactly right. Which makes it a little more complicated. Rather than going with the duration, I'm going with the exact prices, which I think is much more precise. But I think we should understand the.
And they went with dirty prices too, which makes it a lot more complicated.
Of course. So let's just go with. Let's just go through this paragraph, which is the most vital one. It says the 10.625 bond was priced at 141.8281 face amount, and had a val of 0.1 of 0.0741. That is something I should explain to you, and that's done here. Okay, here are the two bonds. Here is the 10.625, and here is the 4.25. That paragraph is actually what is basically explained here. So the settlement date is 11/4/2008. This is the date on the previous page, which is when she was actually considering trading these bonds. The settlement date is always the trading date. Then the maturity, as you know, 8/15/2015. Here is the coupon rate, 10.625. 141.83 was the price of that bond given in that on that page. 3.61% was the yield to maturity, and if you click here, you will see that this is a formula, of course, and the formula is built in there. You can click on it and check that. On the other hand, and the duration also is the formula that I have calculated. So, oops, there is, I have multiplied and by 2. That is why it is not working. So otherwise, the duration can be calculated. Then here is the second bond, 4.25% bond, and that one same settlement at maturity, 4.25%. 105.97 is the price, 3.26. That's the difference of 35 basis points, which is the one that she wants to exploit. Duration has been calculated. You can do it yourself. Now the price change of 1 basis points. This is something that traders actually use. That means how much does the price of the bond change if yield changes by 1 basis point? That means that the yield changes from, let's say, 3.61% to 3.6% or 3.60% or 3.62%. So 0.0001 is, well, if you write it out, it's called val 01. That means what is the change in value of the bond for 1 basis point change in the yield to maturity. That's called val 01. Now, I have actually calculated the price. I think, yes, that, let me show you that one. You will see that the yield I put in is actually different. Notice that the yield I put in is 3.62, not 3. So I have added the yield plus increased the yield by 1 basis points, which is the 0.0001, and then calculated the price, which is an easy way of finding the value, the change in value of the bond for 1 basis point change in yield to maturity. I did it by the direct way, but as Cliff mentioned, you can do it using the duration also. There is no difference between the two. Then I did the same thing for the other bond, 105.91. Here also, I increased the yield by 1 basis point. Give me the price. Now you might ask, what's the value of this thing? Why are we actually using this? And the traders use that because they know that if the bond price, if the bond yield to maturity or interest rate for that matter changes by 1 basis point, this is how much the bond price is going to change. So if they have that number on hand, they can easily answer the question, how much will the bond price change if, let's say, Fed comes in tomorrow and decreases interest rates by 25 basis points? As you know, that there is a new Fed chairman, not now, but from next month, and this is President Trump's choice, so he will definitely be under pressure to reduce interest rates. I have absolutely no doubt that interest rates will be lowered before the elections. There's no question about it. Absolutely no question. That if the Iran war is not settled, and if gas prices continue to be so high, then the president will try to actually soften the economy, at least by reducing interest rates. There will definitely be a spark, no doubt, and reduce the cost of borrowing. So this man will be under immense pressure, and inflation is already running high. That is the dilemma that he will face. That inflation is running high, and this is not the right time to reduce interest rates. In any case, we don't want to get into that controversy, but as you know, this decision can be political. And from a political standpoint, I wouldn't blame him if he tries to soften the economy by reducing interest rate and put this person under pressure. In any case, if that is the case, if that is the market's expectation, or if that were to happen, then you can just multiply this number by 25 and get an approximation of how your bond web or portfolio. So that this is a very, very powerful and informative number. Now, here is the issue, which makes it a little more complicated, that it is what you really want is a matching. That means that if you are buying one unit of the bond and selling another unit of the other bond, then you want the price changes to be matched. Why? Because otherwise there may be a mismatch and the arbitrage may not actually work. So, and that's why this number was calculated, that here, this one is actually changing more. So for a perfect match, or it's called sort of like a hedging ratio, for a perfect match, for every unit of this one, you have to buy or sell more than one unit of this one. Why? Because it's not changing as much. So what you really want is to exploit exact price change so that there is no other factor that could actually challenge the arbitrage or damage the profits for you. So because this number is higher, you will, if you are trading one unit of this, you will be trading more than one unit of that. By how much more? That ratio is 1.1861. None of these numbers really need to be calculated because the computer will automatically do that for you. That these things are not really manually done anymore. These things are done by a computer program, and the computer is programmed to immediately start program trading in that correct ratio. So the program is to take care of all this. So change in price is 0.07, and the change in price here is 0.0625. 1.861. So here you will buy because this yield and this yield will increase. So you will buy the bond whose yield is expected to drop. So you buy 1418.28. Why 1418? Because 141.75 is the price on 100. I must just multiply it by 10 so that you are on 1,000. And I'm not going to explain the accrual. Basically, accrual basically means that I don't know if anybody remembers the concept of accrued interest. Does anybody remember accrued interest? What is that?
They explained it in the case.
Huh?
They explained it in the case.
Oh, good. But can you explain it to the class?
Essentially, interest for the coupon is scheduled to be paid on a certain date, and it counts forward from that date. But it takes time to pay the coupon.
Yes.
And so it may be scheduled prior to you selling the point, which means that coupon goes to the person who sold the bond to you.
That's exactly right. That the person gets the interest from the last coupon date to the trading date. Because from that up to that point of time, he owns the bond. That's called the amount that has been, or rather interest that has been accrued, because when the next interest payment is made, you will own the bond, you will get the entire coupon. So you will have to pay part of that to the person who is selling the bond to you. That calculation is shown in the case also, 23.32. So this is your total cost. Same thing here. So assume both price changes by 17.5. This is just a textbook example, as you can understand. What is 17.5? 35 divided by 2. Because the difference is the arbitrage spread is 35 basis points. I divided that by 2. Then I found the price of 10.625 bond after 17.5 basis points drop is about $13. It becomes $14.31. The straightforward the pricing formula. You make 1304 here, and you make 1252 here. $25.57. It may seem like a small number, but notice the difference between the actual trading cost is roughly about 1431 minus 1049. Roughly, you can say a little less than $400. Make $25 on that within seconds, actually, or maybe the same day. So when you adjust for that, this is substantial profit. Substantial. Question is, how often does it happen? Now, again, if we go by the Wall Street Journal quotation, then it happened today, at least for those two bonds. The mechanics of this model will take you a little time to fully understand. But I think if you really read the case carefully, you will understand it very well. I want to go back to the Wall Street Journal and check if I can find two more bonds that are also trading on the same day. Like for this, for example, here is one, then 815 is one, 2040, and check if there are any arbitrage opportunities there. Notice that there is significant arbitrage opportunity, looks like here also, 5.041 and 4.958. However, look at how different the coupon rates are. So this bond is roughly about a 14-year bond at this point. So my bet is that the second one was issued possibly as a 15-year bond last year. 5/15/2040 was possibly issued as a 15-year bond, maybe last year. I have no idea about the second one at all. But look at how low the coupon rate is. So it's abnormally low.
That's the middle of last decade low.
Yeah, it may be a 20-year bond issued around 2006 or something. I don't know. I mean, we can check that. You can go to the Treasury website and check that. Let's look at the next one. I mean, these are all bonds that are all at the same time. And notice the pairing. Now, I think that was Cliff's talking. Cliff, can you tell us which of these two is on the run bond right now? That means, which of these two do you think is actually trading?
Probably the one with the bigger coupon.
You mean 4.375?
Yeah.
That's correct. And notice that its yield is substantially low. That's exactly what that person was talking about. That when you have a bond that is on the run, that means trading, another one which is off the run and not trading as much, you might see something like this. Let's look at the next pair, 8/15/2040, and same thing. And same thing here. I am tempted to talk to Sam Alam and ask as to whether there is any arbitrage opportunity going on here. Same thing pretty much the 11/15 also. All bonds seem to be out of line, all of these, because one being on the run, the other is off the run. This is fascinating.
If you go back to the case on Exhibit 1,
Hold
where
on.
you look at the amount issued, there's a big disparity between the 4.25% and the 10.26. To what extent is that going to affect how the price moves a lot?
Okay, so this gives you the issue date.
Yeah.
So 1995.
Look at the amount issued of the bonds. One
Yeah,
is like
I
five
see
times
that.
more.
Substantial. Now, that will definitely have an impact. There is no question, but I cannot answer your question.
You would think the 4.25% would be more liquid and not move as much because there's less of it around. There's more of it around, I should say.
Mm-hmm.
Where I would think the 10.25 would move more because there's 5 times less.
The case doesn't Notice,
They didn't
note
get
that.
into it at all, no. But
No, not at all. But you make a good point that actually, I mean, I didn't pay attention to that. I might have, but not today afternoon, at least when I was looking at it once more. But it is definitely intriguing that the market right now seems to be, at least going by these numbers, quite ripe for arbitrage.
the other
At
thing
least
what
textbook
bothered me with
example
the
wise, they are.
what bothered me with the case too is this guy had so little skin in the game. He was borrowing money just to make his 2% margin. So any slightest increase in the spread, and he was gonna have to sell his position.
Oh,
So I
no
don't know
doubt.
that. So I don't know that I would have done this trade at what they proposed it at.
Again, I also felt that the 35 basis points. Now there is actually a part B of this case. I did not include that because that's a two-page thing. I may actually go back. I'll not have time today, but I have access to that. I might actually go back and take a look at it as to what happened to this particular trade, because there is a part B which I did not include in the package because it would cost you for just a two-page follow-up, but it will be interesting to see why there is a part B.
I looked at the dollar yield curve. I didn't over the next to 2015. I didn't see any reason why they would spread. So I would expect that this did work out.
Yes,
But
quite possible.
it was very risky in the beginning, only having a 2% margin, and any slightest increase in the spread, and they were going to have to sell, get a margin call.
Mm-hmm.
That was my just thoughts on this case when I was reading it.
All right, folks, let me come back to the class and let's see what the others are thinking. Tian, can you hear me? Hello, Tian Liu. No response from her. How about Gokul? Can you hear me, Gokul? I called out to you earlier also before the break. Are you there, Gokul? I don't know what's going on. Alex, do you have any questions?
I have none, Professor.
Okay.
Everything makes sense.
Sorry.
On some points, I'll have to go for the video, but other than that, I think it's good.
All right. Very good.
So what did we say about those 2040 maturity bonds? Like when were they probably issued?
You mean the bonds that we were looking at?
Yes.
Well, I mean, we can definitely find out, but the immediate answer to your question, let me go back to that once more. Because I don't want to talk in vague terms.
Well, essentially, at the end of the Obama presidency, they dropped rates essentially down to zero.
Yeah. That's what I was thinking, that there is no doubt that this would be around the time of the last financial crisis, because notice that the question is that if we can verify that around 2006, it was actually not I think that's when the financial crisis started. I remember that I was actually on Wall Street that evening and the market crashed significantly. Anyway, that would be my guess, that the first one, the 1.125, was possibly issued as a 20-year bond at that time. That's the only thing I can think about. And the same for the 11-15 2040 as well. Notice how these two numbers are almost exactly the same.
It makes sense, Professor. It makes sense.
I downloaded the yield curve. For 2006, the 20-year rate was 5.17%.
That is not the case.
So you are saying,
dollar yield curve. That was the dollar yield curve in 2006 for a 20-year bond.
So it will be interesting if I can find out as to when that particular bond was issued.
So you are saying that 125 was issued in 2020 as a 20-year U.S. Treasury bond?
2006. 2006. Yeah, but That's not really what Cliff's statement supports. But I'm
You want me to
surprised.
email you these two, the daily yield curve spreadsheets, and you can
Yeah,
post them
please.
for everybody?
Please, yeah, because it will take me some time to find out from the Treasury website as to when that particular.
Yeah, I downloaded the
uh,
par yield curves for rates for 2000,
Yeah.
2010 and 2010
Maybe
to
somebody
2019.
can use the AI tonight to check if AI can tell us the issue date for the 2004, 2000, the 1.125 bond. Because, you know, that one has about 14 years left to, okay. So if it has 14 years left, then it may be issued 5 years ago during COVID.
Yeah,
As a-
actually, that's my theory. It was issued in 2020 as a 20 years
I
treasury
think you
bond.
may be right. Yes. I think that sounds like the right. Yes.
And how
Yes.
about the other one?
The other one I think was issued last year as a 15-year or so. The 4.375, my guess would be what it was issued last year as a 15-year.
Okay. Understand. Thank you.
Mm-hmm. All right, folks, let me tell you that tomorrow we have another fascinating arbitrage case, this time with merger. The difference between the two arbitrage cases, actually one with respect to fixed income, notice that there is not much risk. That means that in this particular arbitrage, potential profit of whatever that these bonds will definitely, the yields will definitely match at one point of time. Tomorrow, what we will look at, there is really no guarantee on the arbitrage profit. That means it may happen, it may not happen. So tomorrow is a classic example of how a risk actually can be exploited for potential profits. And we will look at that with the merger arbitrage case. There are two cases that I have actually included. One is not an arbitrage, and the other one is the Abbott versus Alza merger case, which is a real life case. I've also posted another one of a takeover that happened in the last couple of years. And the numbers, they are also work out very, very nicely. So if there are no questions, I think I will stop here and we should start thinking about that. And please review if you find time. Please review this case also, because it is actually a little technical, and each of the things that the case describes does have some use in the market. Although you can actually do it the shortcut way, that directly find the price without going for val 01 and all that. But the reason it was included in the case is that the market tends to talk in terms of the val 01. So from a market perspective, that should be something that you should pay attention to. Any questions, folks?
I just sent you the email with the two CSV files for the dollar par yield curve, so you should have that.
Okay.
I replied to the one.
Thank you very much, Cliff,
Yep.
and thank you others. I'm going to stop the recorder at this point of time, and it is usually taking me about 2 hours or so to get the recorder ready. If I do not do it tonight, I will definitely do it tomorrow morning, and I will see you guys at 6 o'clock tomorrow evening again. Thank you very much.
More thunderstorms
Thank
tomorrow.
you, Professor.
Oh, yes.
Thank you.
Thank you,
Thank
Professor.
you, Professor.
Definitely
Have a good evening.
Good evening. Bye.
Thank you, Professor.